Okay, hello everyone. So today we will talk about advanced financial management. Right. So I will teach you about advanced cost of capital. Right. So why it is important to determine accurate cost of capital. All right. Cost of capital is used for NPV calculation. If you use wrong and not appropriate cost of capital, then it will result in an inaccurate NPV calculation. Okay, your answer may be wrong. As a result, you may fail to maximize shareholder wealth, and shareholders may make a wrong decision. Okay, all right. Okay, so in exam, right? So student do not know, whether or not need to use APV, whether or not to use risk adjusted WACC, whether or not need to use the existing WACC, existing weighted average cost of capital. Okay, this is some tips here I give to you. All right, if in the question says, there is a change in the capital structure, meaning that there is a financial risk changes. All right, so you will be required to use APV method. Okay. However, if there is no change, all right, meaning that in this case the capital structure is still the same, all right. So in this, however, the company want to go to the new business, it means that there is a risk in business risk changes. Okay, business risk is changes. So you need to use risk adjusted WACC. Okay, risk adjusted weighted average cost of capital. All right. Okay, if there is no change in capital structure and there is no change in your business, all right, you still maintain your business. So you can use the existing WACC, all right? Okay, so take note of that, okay? If yes, this one is yes. Okay, this one is yes. If there is changes. Okay, if there is no changes, okay, if both of these risks is no change, then you use existing WACC. All right. Okay, before we go to question, okay, let's learn about the beta family. Okay, so beta family in exam, the most famous one is beta equity and beta asset. Okay, beta equity, okay, what is it? Okay, it contains business and financial risk, while beta asset, it contains business risk only. Okay, okay, how about beta debt? Okay, in advanced financial management, you can assume that beta debt is equal to 0. So the formula here is beta asset equals to beta equity times value of your equity over value equity plus value debt over value debt 1 minus tax. Okay, all right, let's do some question, all right, to show you. Okay, so I will use BPP Advanced Financial Management Practice Revision Kit. Okay, so let's discuss TISA. Okay, it is June 2012 exam. All right. Okay, so let's read the question together. Okay, TISA Co is considering an opportunity to produce an innovative component which, when fitted into motor vehicle engine, which enable them to utilize fuel more effectively. So meaning that in this case, TISA Co, okay, meaning that they want to produce this component, innovative component for engine component. All right. So they want to venture into a new business. Okay, the component can be manufactured using either process Omega or process Zeta. Okay, although this is entirely new line of business. Okay, highlight that this is entirely new line of business. So meaning that in this case, this will be all right a business risk for a company. Right? It is an opinion that developing either process over a period of 4 years, then selling the production right at the end of 4 years to another company may prove lucrative. All right, so they want to venture into the new business here. Okay, so this process Omega, process Zeta. Okay. TISACO has 10 million 50 cent trading at, okay, TISACO has 10 million 50 cent shares trading at 180 cents. Okay, so meaning that in this case, currently they have 10 million shares. All right, so the current value of their shares, okay, 10 million times, okay, 180 cents is actually $1.8. So 10 million times $1.8 here. Okay, then you will get the value of equity. Each loan have a current value 3.6 million. And that average after tax cost of that is 4.5. So meaning that in this case, KD1 minus tax is 4.5. Okay. TISA capital structure is unlikely to change significantly following the investment in either process. So meaning that in this case, all right, our current capital structure will not change. So meaning that well, financial risk, all right, is still the same. Okay, because you not change your capital structure. All right. So in this case, you want to go to the new business. All right. Okay. First of all, your capital structure is unlikely to change. So you will not use APV. All right. So let's go to the second question. Okay. Is there any business risk changes? Yes, we have. Okay. We have. All right. We have counted this word. All right. This is entirely new line of business for TISACO. So meaning that in this case, you will move. Okay. You will use. Okay. Risk adjusted WACC. All right. Okay. Let's read. Okay. Elfuco manufacture electronic parts of the car, including the production of components similar to the one being considered by TISACO. All right. So most likely, you will use Elfuco as your proxy in your calculation. Okay. Elfuco equity beta, okay, BE is 1.4. Okay. So equity beta, all right. In this case, okay, equity beta is as we mentioned just now, okay, it contains business risk and financial risk. Okay, it is estimated that equivalent equity beta for other activity, excluding component production, is 1.25. So, in this case, okay, equity beta of other activities beside component production is 1.25. Take note of that. Elfuco made, okay, Elfuco has 400 million, 25 shares in issue trading at 120 each, 120 cents each. So meaning that in this case, okay, the current values of shares is 400 million times 120 cents is actually $1.2. Okay. Is that finance consists of variable rate loan redeemable in 7 years. All right. Okay, so it is that. Okay. The loan paying interest at rate 122 basis point have a current value 96 million. So this is the value of that for Elfuco. Okay, it can be assumed that 80% of Elfuco debt finance and 75% of Elfuco equity finance can be attributed to other activity excluding the component production. So meaning that in this case, 96 million, okay, this debt finance is, okay, 80% of 96 million belong to the other activity. All right, 75%, okay, of this 100, okay, $1.2 times 400 million, okay, 75% of that belong to the other activity. All right, and the rest of, okay, 20% of 96 million belong to the component, the engine component production. All right, and then 25% of this equity, 400 million times $1.2, all right, belong to, okay, component production. Okay, all right, can be attributed to other activity excluding the component production. Okay, both company pay annual corporate tax at the rate of 25%. So this is our tax here, okay, to 25%. The current base rate, okay, current base rate is your risk free, okay, 3.5%, and the market risk premium is estimated at 5.8%. The market risk premium is your RM minus RF, okay, in the CAPM calculation. Okay. Provide a reasoned estimate of the cost of capital that TISA should use to calculate the net present value of the two process. Include all relevant calculation. So in this case, all right, we want to know, okay, the cost of capital of TISA, all right, when they want to calculate net present value later. All right. Okay. So I show you some calculation. Okay. All right. So TISA is planning to venture into new line of business. So, and also they want to maintain the current capital structure. Okay. So take note of that. So in this case, so what? So cost of capital, so you will use the risk adjusted WACC. All right. So in order to calculate the risk adjusted WACC, okay, you want to know, okay, the beta asset. Okay, the beta asset. Okay, you want to know the beta asset of the component in your calculation later on. All right. However, since you currently do not have that business, you will use LFU as a best proxy, all right, to risk adjusted WACC. Okay, let's look at LFU. Okay, LFU currently value of equity they have is 480 million. Okay, so you have previously you have calculated the shares there. Okay, so 480 million, all right, and the value of that is 96 million. So beta equity that have been given 1.4. Okay, that is the total. Okay, let's apportion it. Okay, other activity 75% of value of equity. So meaning that in this case 360 million. All right. So in the component, all right, it is 25% of it. So in this case, all right, so it is 25%. So it's 120. Meanwhile, for value of that, okay, 96 million, 80% is 76.8 million. Okay, the other 20%, 19.2 million, okay, belong to this component. So, it's been given that beta equity for the other activity is 1.25. You do not know currently the beta equity for this component. All right. So, let's proportion it. All right. So, beta equity. So, you have know the equity currently 75%. This one is 25%. All right, so you proportion it. So total beta equity 1.25 times 0.75 plus, okay, you level this beta equity as Y. This is unknown because you do not know. All right. So let's do some calculation there. All right. So total beta equity is 1.4. So 1.4 is equal to 1.25 times 0.75 plus Y times 0.25. So you do, okay, you do calculation there. And then you will get Y is equal to 1.85. Okay, remember, this is beta equity. So beta equity consists of, okay, that, okay, consists of business risk and financial risk. You only want the business risk for your calculation, for your company. So meaning that in this case, you need to ungear. So beta asset is equal to beta equity over value of equity. Oh, okay. Sorry, beta asset is equal to beta equity times value of equity over value equity plus value of debt 1 minus tax. So you just use the figure here. All right. So beta equity 1.85, you already calculate that. Okay, 120 million, where do you get? Okay, this one. You get this one for the component 120 million. Okay, so 120, okay, 19.2. All right, already given to you. All right, and then 1 plus 0.25 is your tax rate. Okay, so you will get the beta asset 1.652. All right, this is beta asset for the LFU. Okay, you need to regear to TISA because currently we want to calculate for TISA. So beta equity. Okay, so you just, okay, play around with this formula. So you want to calculate beta equity, right? So in this case, okay, beta asset, all right, over, okay, beta asset times VE plus VD1 minus tax. Okay, it's mathematics here. And then VE will come below. So over VE. All right, so 1.625, okay, 1.625 times, okay, this one 18, okay, your value of equity. All right, so 18 million plus 3.6, okay, is your debt, value of debt. All right, okay, times 1, okay, times 1 minus 0.25, okay, because you want to calculate value of debt 1 minus tax, okay, over 18 million. Okay, so 18 million is value of equity. You will get beta equity 1.9. All right, so the cost of equity, all right, by using CAPM, so I hope you still remember. So you will use the formula RF plus RM minus RF over VE. So you already got the beta equity 1.9. All right. So in this case, 3.5 is your risk free, and 5.8 is your risk premium. The risk premium is RM minus RF. So risk market minus risk free. Okay. So you will get KE 14.5. All right. So that is KE. Okay. So you want to calculate weighted average cost of capital, you need KD. So KD after tax, they already given you 4.5%. So you just calculate, okay, risk adjusted WACC. So VE, KE plus VD, KD1 minus tax over VE plus VD. All right, so you just put the figure 18 times 14.5 plus 3.6 times 4.5 over 18 plus 33.6. So you will get answer 12.8. Okay, that is the answer. All right, everyone. Okay, thank you.